Welcome back to Investing Talk Podcast. Today, we're unpacking a question many of you have sent our way. Is now a good time to buy into RCAT Holdings? This company operates in the fascinating world of drone technology, and we've compiled a stack of sources from their latest SEC filings and recent analyst notes to market data and, technical charts to give you a really clear picture. Our mission, as always, is to sift through all this info, pull out the most important insights, and help you understand the full story behind RCAT Holdings quickly and clearly. And hey, if you find value in these insights, please consider subscribing, liking, and leaving a comment. Your engagement truly helps us bring more of these analyses to you. And if there's a specific company you'd like us to examine next, just drop a comment below. You can also consider buying us a coffee if you appreciate what we do.
Yeah, and what's truly captivating about RCAT Holdings is its positioning. It's in such a high-octane sector. Drone technology and autonomous vehicles aren't just buzzing with innovation. They're also, battlegrounds of intense competition and rapid technological shifts. It's a market where the potential is huge, but, so are the stakes.
Absolutely. It's a space that definitely grabs headlines. So, okay, let's begin by unpacking the core of RCAT Holdings. We're looking at a player in this drone tech arena that's clearly trying to make some big moves. What are the financial fundamentals, essentially their financial engine? What do they tell us about the company's health and direction?
Right. Fundamentally, RCAT Holdings has recently made a bit of a strategic pivot. They're expanding into unmanned surface vessel technology, and this expansion was notably backed by a pretty substantial $46.75 million registered direct offering completed just this past June 18th. So this move clearly signals their ambition, right? And also their need for capital to chase these new frontiers. However, while their recent quarterly reports, Q2 2025, did show some modest top-line growth, primarily driven by new product lines in these autonomous systems, profitability, that continues to be a significant challenge for them. Operating expenses, particularly because of heavy investment in R&D, are quite high, and that really constrains their net margins.
That's interesting. Modest growth in what everyone sees as a high-growth sector. Does that maybe suggest a deeper issue with their product market fit, or is it simply that the competition is just that fierce, even with these new ventures? And more broadly, what does all this mean for their overall financial health, beyond just the top line?
That's a really crucial question. Yeah, the modest growth indicates they're growing, but maybe not at the pace you might expect for a company in such a dynamic, sometimes explosive sector. It could be a bit of both, definitely intense competition and the inherent challenges of commercializing cutting-edge tech. Regarding their financial health, that recent equity raise certainly injected a significant amount of cash. Put cash in the coffers. Those proceeds are primarily earmarked for general corporate purposes and specifically accelerating the development of their unmanned vessel technology. They've also been actively managing their debt. For instance, they amended existing convertible notes to remove certain prepayment rights and payment options. Gives them more flexibility. However, it's not all good news. This strategy also introduces a moderately elevated dilution risk for existing shareholders. Think of it this way. Every time they issue more shares, your slice of the company, your ownership, and its future earnings per share, it gets a bit smaller. Unless, of course, the company grows exponentially to make up for it. And our analysis of prior filings shows that their cash flow from operations hasn't consistently covered their expenses, meaning they've often had to rely on external financing just to keep the lights on and fund these ambitious projects.
Okay, so it sounds like they're kind of in a continuous funding cycle, which, can be a double-edged sword for shareholders. And in a market as competitive as drone technology, where does RCAT Holdings actually stand? Are they carving out a unique space, or are they like just another fish in a very big, very crowded pond?
That brings us right to their competitive position. They are indeed targeting drone technology and autonomous vehicles, and these sectors are notorious for rapid innovation and really strong competition from established firms that often have far greater R&D resources, deeper pockets. Now, RCAT Holdings is attempting to differentiate itself, particularly with this expansion into unmanned surface vessels, and by pursuing direct government and institutional sales rather than, say, going after the broader consumer market. This is a high-stakes bet, creating almost a bespoke defense tech channel that could insulate them from the consumer drone wars. However, our sources suggest that while this is a promising avenue, there's limited proof of concept so far, and they still, frankly, lack a significant scale advantage against the real industry leaders. They're running a constant race to innovate, spending heavily just to stay competitive, rather than necessarily carving out a dominant, immediately profitable niche. It's almost like they're trying to win a marathon by running a series of sprints, constantly needing fresh water bottle handoffs,
That analogy, that paints a very clear picture. Okay, so the financial engine sounds like it's still finding its rhythm, and their competitive advantage is, well, a work in progress. But what's the market's overall read on this? Are investors buying into the dream, despite the numbers? How does the market currently value Red Cat Holdings, especially given these challenges you've mentioned?
Right. Well, given their consistent net losses and, the lack of consistent positive earnings, Red Cat Holdings, like many early-stage growth companies, it doesn't have a meaningful price-earnings ratio, or PE.
Right.
That metric we often use for profitable companies doesn't apply here. So instead, we have to turn to other valuation metrics. As of August 28, 2025, the stock trades at approximately $9.04 per share. Its price-sales ratio, the PS ratio, which compares market cap to total revenue, is notably elevated compared to industry averages for aerospace and defense. What this elevated PS ratio signals is that investors are essentially paying a premium for every dollar of Red Cat's revenue. They're pricing in future growth potential that isn't yet reflected in their current, more modest earnings.
So investors are definitely pricing in a lot of future potential, a lot of optimism there. What about their price-book ratio? That gives us a look at how the market values the company relative to its assets, right?
Yeah, the price book or PB ratio analysis, it's also complicated by their frequent equity offerings. Every time they issue new shares, it tends to inflate their book value. So the PB ratio might be less indicative of operational success and more just a reflection of these capital raises. From a broader valuation model perspective, something like a discounted cash flow model, a DCF, it isn't really practical here. DCF models rely heavily on projecting future cash flows, and with Red Cat's ongoing net losses and, frankly, unpredictable future earnings in this rapidly evolving market, making reliable long-term cash flow forecasts is incredibly difficult, almost impossible. So when we do a relative valuation comparing them to established peers that do have stronger profitability, Red Cat Holdings consistently appears to be trading at a premium. This suggests that the current market price is largely driven by speculative interest in their future potential rather than their current financial performance.
Okay. Now, for many of our listeners, the charts are kind of the heartbeat of the market. What's the technical picture telling us about Red Cat Holdings' recent price action and trends? Is there any momentum building, or is it just sort of stuck in a holding pattern?
Looking at the charts, yeah, the stock has recently traded in a relatively tight range, specifically between about $8.70 and $9.20. What this tight range tells us is that neither buyers nor sellers are really taking control right now. It's a bit of a stalemate. It suggests the stock is simply waiting for a major new piece of information, a catalyst to dictate its next move. Its volatility has been quite closely linked to that recent equity offering we discussed and various product announcements. We can identify clear support levels around the $8 mark. Buyers tend to step in there, while resistance is observed around $10, where selling pressure usually picks up. This pattern indicates limited momentum. It implies the stock needs a strong, fresh catalyst to break out significantly in either direction.
And when we look at common technical indicators, like moving averages or RSI, what are they whispering about the stock's current health and potential path?
Right. Putting these signals into context, let's look at the moving averages. The 10-day and 50-day moving averages currently suggest a neutral to slightly bearish trend, which indicates a lack of strong upward momentum in the short to medium term. The Relative Strength Index, or RSI, which measures the speed and change of price movements, it's currently hovering around 45.55. What this practically means is it's neither in an overbought nor an oversold condition. So you probably shouldn't expect a quick rebound or crash purely based on this indicator. It's just reflecting the key piece of news that has dominated discussions is definitely that $46.75 million capital raise we mentioned, specifically intended for their unmanned surface vessel development. That was a clear statement of intent and obviously a necessary cash infusion. However, it's also important to note that we haven't seen any major analyst upgrades or downgrades reported in the last month, which suggests analysts are largely, holding their current positions, maybe waiting for more concrete developments before they make a call.
Okay. And insider activity, which you just touched on, can often be a potent indicator of confidence or maybe concern from those closest to the company. What have we seen there?
Yeah, that's a crucial aspect here, insider confidence. We've seen a noticeable pattern of recent insider selling. Specifically, Form 144 disclosures, those are basically pre-notification filings, when insiders plan to sell shares on August 25th, 2025. Indicated a proposed sale of 10,000 shares. And this follows prior sales within the last week totaling about 26,833 shares, valued at roughly $250,000. This kind of selling from within, especially when it's not balanced by significant insider buying, typically points to neutral or maybe even slightly negative insider confidence. It suggests that those who know the company best might be taking some chips off the table rather than, say, doubling down. So overall market sentiment remains cautious. This insider selling, combined with the lack of significant buy reports from analysts, it does temper some of the optimism.
Right, so on one hand, a big capital raise for a promising new venture, but on the other, cautious sentiment in insiders reducing their stakes. Given all of this, what are the potential triggers that could really move Red Cat Holdings stock, both short-term and, over the longer horizon?
Okay, short term. The primary catalyst would be the effective and, importantly, visible use of those recent funds, especially for new product launches in that unmanned surface vessel area. Any concrete progress or successful trials reported there would be a significant boost. Also, investors' eyes will be keenly on their next quarterly earnings report, expected in September 2025. People will look for fresh guidance and product updates, anything that provides a new narrative, longer-term prospects. They depend heavily on the successful commercialization of their next-generation autonomous systems, moving from R&D to actual revenue-generating products, and, critically, securing substantial government contracts. Those defense-related deals could provide the stability and scale they currently seem to lack. We could also see some speculative interest pop up if there's talk of industry consolidation or M&A activity, as larger players maybe look to acquire innovative tech.
Makes sense. But with opportunity, especially in an emerging sector like this, there's always risk, lots of it sometimes. What should a potential investor be really aware of when considering Red Cat Holdings?
Absolutely. The risks are substantial and multifaceted.
Yeah.
Stock-specific risks. You've got the continued equity dilution from direct offerings, that constant expansion of the share count we discussed, which can erode existing shareholder value. There's also the significant challenge of successfully commercializing new product lines. Developing cool tech is one thing. Turning it into a consistently profitable product is a whole different ballgame. We also need to consider the risk of delays in regulatory approvals, which are pretty common in defense and advanced tech sectors, and maybe slower than expected customer adoption, too. From a broader market and sector view, this is a highly competitive drone and robotics sector, super competitive. They face a constant threat of technology obsolescence. What's cutting edge today might be outdated tomorrow. You also have to factor in increased regulatory scrutiny and wider macro risks like shifts in defense budgets or just general market volatility. All these risks are actually detailed quite thoroughly in their latest 10-K filing. Every potential investor should definitely review that.
That's a really comprehensive look at both the potential upsides and the potential pitfalls. So bringing it all together for you, the listener, what's the overall investment thesis here for Red Cat Holdings based on everything we've uncovered?
Yeah, if we synthesize all these points, try to boil it down. Our overall rating for Red Cat Holdings, based on these sources, lands at a 4 out of 10. While that recent capital raise certainly provides necessary liquidity and the potential for new product expansion, which is good, the persistent losses, the frequent share offerings leading to dilution, and that significant insider selling, it all diminishes confidence in any substantial short-term upside. It's a company with, intriguing potential, but a really challenging financial reality right now.
Okay, 4 out of 10. So for different types of investors, maybe someone thinking short-term versus long-term, what does this rating practically mean for how they might approach it?
Right. For short-term trading, Red Cat Holdings is considered high risk. That's mainly due to its volatility and a distinct lack of clear catalysts for immediate upward movement. It's probably suitable only for highly experienced swing traders who are prepared for significant price swings and, frankly, monitor company news very closely. For long-term investment. At its current levels, it's just not that attractive, primarily because of the ongoing dilution risk and a very uncertain kind of winding path to consistent profitability. Prospective long-term investors would probably be wise to wait for a clear stabilization in its fundamentals. That means seeing consistent revenue growth, improving margins, and much tighter execution from the company's management, proof they can deliver. Essentially, you'd want to see them move beyond the potential phase and demonstrate tangible financial performance before considering a long-term commitment.
So what does this all boil down to for you? Red Cat Holdings is a company with genuinely intriguing technology operating in a high-growth sector. But it's clearly facing significant hurdles on its path to profitability and stability. It's a prime example of why looking beyond just the headlines and really getting into the nitty-gritty details truly matters.
Yeah.
It feels less like a steady investment right now and more like a speculative bet on future breakthroughs and maybe those big government contracts landing.
Yeah, and this raises an important question, doesn't it? When does innovation truly translate into tangible, consistent value for shareholders? It's not always a straight line, especially in these emergent competitive markets where the technology can absolutely dazzle, but the business model struggles to keep pace.
Exactly. So for you, the listener, the ultimate takeaway here is to carefully weigh that speculative potential, the promise of groundbreaking technology, against the very clear risks. Risk presented by frequent dilution and a challenging, often elusive path to actually making money consistently. How do you balance the promise of new technology against the realities of financial performance? Something to ponder as you consider companies in these dynamic and exciting but often quite volatile sectors.